Let's turn now to our segment highlighting the best of Bloomberg Intelligence. Bringing us more is Gina Martin-Adams, Bloomberg Intelligence Chief Equity Strategist. So when you write fairly bad earnings season, what does that mean? Qualify that for us.
Yeah, fairly bad is one of the worst beat rates in history, one of the most misses in history. Price reactions to earnings misses, the worst in our record books. Absolutely, just a really rough season. Margins falling year on year for net income as well as operating margin estimates. EPS excluding the energy sector is falling year on year now. And analyst estimates just capitulated across the board. Analysts are now expecting recession to emerge into 2023, whereas before the earnings season started, they weren't. So really across the board, not a lot of positive came out of this earnings season.
And yet the broader market's up 10% this quarter so far.
Yeah,
Why?
well, a couple of things. First, the market, as we talked about in September, priced for recession. So the market priced a recession emerging in the numbers. The analysts are now capitulating to the likelihood for recession. The market always moves in front of the numbers, right?
Yeah.
So that's part of the reason. But I think the other part of the reason is over the course of the last few weeks, it's been pretty clear that throughout earnings season, as the bond market was rallying, the equity market was able to take some solace in that as a signal that maybe the Fed increases that we've tolerated so far this year will at least slow, if not pause, coming into 2023. So I would say the bond market has largely driven the equity market, that and the fact that the equity market effectively was already expecting a really rough earnings season in 3Q.
Okay, so the bond market is driving the equity market. So when that happens, it's no surprise to see utilities, REITs, financials moving in tandem with those rates because they are rate sensitive. Yet tech has become increasingly sensitive to rate changes as well. When times are good, we don't really talk about technology as interest rate sensitive and tied to the broader macro environment.
Right.
Why is that different now?
Yeah, so because rates are moving higher, it's different, right? For 15 years, we had rates moving lower. Really, for 40 years, you've had rates moving lower the vast majority of the time, except for small spurts in which rates moved higher. Rates have moved higher at a remarkably fast pace so far this year. We're resetting expectations across the board. We had an embedded expectation that we were going to continue to pay elevated premiums for this long-dated cash flow companies, the longer duration companies in the market. We had a captivation with innovative stocks, high R&D for level of sales stocks and the like. And that captivation has really slowly been depleted over the course of this year. As interest rates move higher, you cannot pay up for those type of stocks because their cash flows are longer dated. So when you discount those cash flows back to present, those cash flows are worth a lot less today than they were in the past. That's the big change this year relative to past years. We've not contended with interest rates accelerating this fast.
So based on what you just said, does that mean that stocks are still too expensive?
No, stocks at large are actually not too expensive relative to interest rates. The S&P 500 is trading about where it should trade relative to the two-year Treasury yield. That said, there are segments of the market that are still too expensive, and some of those segments are the innovation stocks, the technology stocks that had this built-in embedded premium over the course of the last cycle, and we're just slowly seeing that premium deplete. So something like tech as an example. This is the longest duration sector in the S&P 500. It has the most cash flows as a share of overall cash flows that are far out into the future relative to other sectors.
But there was a growth story attached to a lot of those companies.
Yeah, the growth story, again, is enduring into the long term. Not a short-term growth story, but a long-term growth story. And that's what we embedded into valuations.
Right.
They traded tech sector alone in the S&P 500 trades at a 25% premium to the index at large. It shouldn't trade at a 25% premium when interest rates are higher. Even pre-pandemic, it traded at a level that was lower than today in terms of premium.
What about communication services? Because you've got names like Netflix, or I should say Meta in there, and then you look at consumer discretionary, which has Amazon and Tesla, which are part of that growth techie world, but can affect the valuation of consumer discretionary overall.
Absolutely. Yeah, it is a very confusing picture. Thank you for pointing it out.
When are they going to reweight all this?
Exactly. Wouldn't it be nice if they just lumped them all
together?
But communication services is actually one sector that finally has derated. We have seen, as on the heels of the Netflix and Facebook and Meta, news of the course of the last year, a lot of optimism depleted from that space. So it does trade in line with what we would suggest for interest rates. The problem is that space also, we're really even thinking about changing our long-term growth forecasts for that space, right? The consensus is really addressing their expectations for growth. It still is high duration to a large degree. Discretionary is also very much a tale of two worlds. You've got the Amazon and Teslas of the world, of the discretionary space, but then retail, for example, had just been beaten up into a pulp over the course of much of this year. So you have really viciously moving parts in that group too.